Welcome to the fourth lesson of our beginner's course on financial literacy. The topic we're focusing on today is debt. Understanding how debt works can help you manage it effectively and even use it as a tool for achieving your financial goals. Debt is money you borrow from someone else, usually with the agreement that you'll pay it back over time with interest. The key is to recognize that not all debt is bad. It's how you use it that makes the difference. Good debt helps you build wealth or improve your life. Think student loans for education or a mortgage for a home. Bad debt, on the other hand, is typically high interest and used for things that don't appreciate in value, like luxury items bought on a credit card. When you borrow money, you pay back more than you borrowed because of interest. Interest is essentially the cost of borrowing money, and it's expressed as a percentage of the loan amount. For example, imagine you borrow $10,000 at an annual interest rate of 5% and will pay the full amount after 6 years. This means that each year you'll make an interest payment of $500 or a total interest payment of $3,000 over 6 years. Let's break down some common types of debt. Credit cards. Convenient, but often come with high interest rates. Always aim to pay off the full balance each month to avoid interest charges. Student loans usually have lower interest rates and can be an investment in your future earnings. Mortgages, a type of secured debt used to buy a home. They typically have lower interest rates and long repayment periods. Personal loans, unsecured loans that can be used for various purposes, but they often come with higher interest rates than secured loans. Understanding the type of debt you have can help you manage it more effectively and develop a repayment strategy. Managing debt doesn't have to be overwhelming. Here are some strategies to keep your debt under control. Know what you owe. Start by listing all your debts, including the balance, interest rate, and minimum payment for each. Prioritize high-interest debt. Use the debt avalanche method to pay off the debt with the highest interest rate first while making minimum payments on others. Alternatively, consider the debt snowball method. Pay off the smallest debt first to gain momentum and motivation, then move on to larger debts. Whichever method you choose, consistency is key. Even small, regular payments can make a big difference over time. Debt can quickly spiral out of control if you're not careful. Here are a few common traps to avoid. Minimum payments only. Paying just the minimum on your credit card can keep you in debt for years. Always try to pay more when you can. Impulse borrowing. Think twice before using credit for non-essential purchases. If you wouldn't buy it with cash, consider skipping it. Ignoring the terms. Always read and understand the terms of any loan or credit agreement before signing. Being mindful of these pitfalls can help you stay in control of your financial journey. Finally, let's talk about how debt can be used wisely. Borrowing to invest in your education, start a business, or buy a home can be a smart move when done responsibly. The key is to ensure the potential benefits outweigh the costs. Remember, not all debt is bad. It's about making informed decisions and using debt to support your goals. And that wraps up our lesson on understanding debt. In our next lesson, we'll explore strategies to pay off debt in more detail. Hope you've been enjoying our financial literacy course so far. Don't forget to like this video and subscribe to our channel. Initial return. Until next time, take care.